Good morning, everyone. It's Tuesday, March 29th. I'm Marv Eisen of Timeless Dollar. And beginning the day, as we do every day, and as you should every day, is looking at the morning economic calendar to see if there are going to be any announcements during the day that are going to be moving the market. Now today, there are a couple of 9 a.m., there's a couple of 10 a.m. related to job openings, consumer confidence is down a little bit, but nothing is going to move the market according to, as I see it on the economic calendar. Moving over to the morning news, futures are in the green. Bulls had a good day yesterday. They had a little scare in the morning, and I'm going to get to that in a minute. Oil is down a little bit. Oh, look, it just broke 199.99 a barrel. That's definitely good news for the market. That's what the market wants to hear. Although the 10-year treasuries are up to 2.47, so there's usually an inverse relationship between equities and bonds. At any rate, it's not going to affect our day trading activity, so let's move over to day trading. Now, I have yesterday's chart up here, and the reason I do that is because I don't show you today's prices because I'm not going to show you my trading zone. And as you know, if you've been watching my videos for any length of time, or if this is the first video of mine that you're seeing, I always calculate the trading zone per Taylor's book method plus a few smoothing averages. I always calculate that prior to the market open. And I make it available, by the way, as a subscription if you want to check it out at my site at timelessdollar.com. But nevertheless, it's a difficult calculation, but extremely useful. Now, the trading zone generally tells me where the prices are most likely to trade on that particular day. And yesterday, here's an example. But the trading zone alone is not enough. You have to know how to use it and what the implications are. One of the things that I should tell you up front is that you can make good use of the trading zone by using it along with what you know or what you should know about trading. I mean, if you don't know anything about trading, then all this is gobbledygook to you in the first place. But the trading zone is a good indication of where the market is going to trade. And yesterday, the trading zone started out at a support at 4,500 and a resistance of 45.48. So relatively narrow for the Emini. This chart, there's 5 points between each horizontal line, and you're looking at a 3-minute candle. So at any rate, one of the things that one of the valuable pieces of information that you want to look for as a trader is the intraday high or low. Now, interestingly enough, and I'm going to give you a secret here, it's not a big secret, but still in all, it's very valuable information, is that the intraday high or low is usually put in within the first half hour to hour of the trading day. Usually, not always, but usually. Actually, in trading, nothing is always, all right? You can't count on anything being written in stone in trading. But nevertheless, the trading zone used in conjunction with the intraday high or low is good information on which you can base a trade that is going to be likely profitable. So here we have the morning. The morning opened up here at about 45.30. And there was a small gap. It quickly closed that small gap. And the market traded up to within a couple of points, I think 2 points of the resistance line of our trading zone. So that was an indication that you should have gotten off if you know about the trading zone and how to use it. All you knew at this time was the trading zone resistance was at 45.48, and prices were approaching it at 45.46, so 2 points away. So that would have been a trade, if you had gotten on down here, that would have been a trade that would indicate that you should exit the trade. And of course, in particular, in conjunction with the stochastic being overbought. At any rate, as I said, an important piece of information that you should look for is the intraday high or low. So here, just after the open, a low is put in. And a high was put in here at just about 10 a.m. The market traded back down to the previous day's close and then traded up a bit but did not pierce the high over here that prices had put in at 10 a.m. So here at, let's see, it's 11, it's an hour later, if you were still trading, you'd notice that this high did not pierce this high, okay? So this could have been assumed to be the intraday high. Having known that, with that information, and seeing the trading zone, the price is still up here close to the top of our trading zone, we could take a pretty good guess, and I'm calling it a guess, that prices would not trade above this level. So if we got on here, it was a pretty good guess that prices had reached their zenith over here at 45.46, and we were safe placing a trade here. When I say safe, you're never safe when you're in the market. But what I'm talking about is relatively low risk. So this trade here would have been relatively low risk, particularly again at an overbought stochastic. And this trade proved to be profitable, trading down to 45.10 just 1 hour later. So this was a very profitable trade. But of course, then you would have had to make an exit. You would have had to cover your short. If that was the only trade you made for the day, that would have been fine. I'm not going to go into the rest of the day. I'm just talking about the intraday high and using that information on which to base a trade. Ultimately, this was not the high of the day. That high was taken out right over here at about 245. And the market traded up from there. And look what happened at the close. Just 3 minutes prior to the close, market made a push up of almost 10 points. So that was sneaky on the part of the bulls, wasn't it? But nevertheless, this over here, this high did not take out the previous high, was an indication that the market had reached a high level. And based on the trading zone, which showed us that the trading area would be 48 points, based on that information, well, where was those 48 points going to be? Well, if this was the high of the day, we could say, well, the 48 points was going to be down here, which in fact it just about was, right? So take a guess based on your knowledge of where the trading zone is, and that gives you information not just for support and resistance level, but also a range of prices that the market will likely traverse for the day. So using that information in conjunction with what appears to be the intraday high or low, you can make a relatively low risk trade almost always and be profitable with it. So that's my video for the day. Thanks for watching. This is Marv Eisen for Timeless Dollar. And if you're looking for some training on how to be a better E-mini trader or micro E-mini trader, check out my site at timelessdollar.com. And of course, I make the Trading Zone available as a subscription service, very inexpensive, well worth it, very well worth it. And I'm not saying that just to blow smoke. This is important information, and this is valuable information. So thanks for watching again. Trade safely, use a lot of patience, and I'll see you in my next video.